Hello there, I'm Joe Dragoni from your Management 310 class, and this is my Session 8 assignment looking at market efficiency of the GameStop stock. So just a little bit of overview about our investigation we're going to be going into for now. So we are investigating market efficiency using GameStop, the GameStop short squeeze, the big event where GameStop stock surged to very high returns from 2020, and it was in early 2021 that it had the super high returns. So we're just going to be looking at the price behavior relative to the efficient market hypothesis predictions. And then one of the first steps we'll be going into is verifying the statement of GameStop trading at 4 cents in August of 2020 against the historical data, which we'll go into in a second. And then we'll look at the event timeline of August 2020, where GameStop was nearing bankruptcy levels. September 2020, where Ryan Cohen, the founder of Chewy, acquired 30% stake. January 2021, the big event where Wall Street Bets Reddit subreddit drove the price up to $483 a share, as led by Roaring Kitty. In February 2021, after that event, congressional hearings about market manipulation and the stabilization of the price of GameStop post event, looking at today. So some other key points to look at is the short interest peaked at 140% float. Retail trading volume increased tenfold during the squeeze. Trading restrictions implemented at the peak by Robinhood after they saw what happened with the influence of the Reddit account to have people invest in that stock. Hedge fund Melvin Capital sustained 53% loss, and analyst fundamental value estimates being $10 to $40 per share. So now some required analysis. Some points we'll be looking at over the course of this video being verifying historical price data and document corrections, testing which form of market efficiency was violated, whether it was weak, semi-strong, strong, or if all of them were violated, evaluating whether rational investors could have profited systematically, comparing efficient market hypothesis predictions to observed behavior, so the real behavior that we saw compared to the hypothesis predictions, and then assessing behavioral finance explanations for observed anomalies. And then we'll do all of this using the driver framework. So the first stage of the driver framework, the define and discover stage, looking at our goal of investigating market efficiency of GameStop from 2020 to 2021, the event timeline that we went over already, and verifying the facts stated in the problem. So just kind of going into that goal a little bit deeper, we want to determine whether the 2021 short squeeze of GameStop constitutes definitive anomaly that invalidates the efficient market hypothesis, or if it can be explained as a rare and rational, though very extreme, as we saw, market event driven by market structure and new forms of information flow, aka social media. And did the market behave efficiently, or were there behavioral factors involved? So basically, we're just trying to determine if efficient market hypothesis is still a valid model for understanding financial markets in the modern age of social media and widespread retail trading. Some of the actions we'll take, using assistance from AI, mostly Google Gemini, a little bit of ChatGPT, as well as historical data and learnings of the efficient market hypothesis, as well as past concepts from this class, like CAPM, to analyze GameStop investment and understand how certain anomalies can provide evidence against market efficiency. Do the events of the timeline have anything to do with the price jump? And then testing the form of market efficiency that was violated. So looking at what the different forms of the efficient market hypothesis here in this define and discover stage, just to make sure we understand the financial concepts from this lesson. Weak form efficient market hypothesis is that prices reflect all past price and volume information, and technical analysis does not work to provide new information for investing. Semi-strong form, EMH, where the prices reflect all publicly available information. So fundamental analysis doesn't work to get an edge over the competition for investing. And then strong form, EMH, is the price reflect all information, including private information that companies or market insiders might have. So insider trading doesn't work, which insider trading is normally illegal. So this wouldn't help anyway. And then kind of looking at that critical first step we talked about already, about whether GameStop traded at 4 cents per share in August of 2020. So just to kind of validate this claim, I used Yahoo Finance, pulled up GameStop, and looked at the entire history of GameStop stock. As we can see here, starting in 2002, it was mostly the returns mostly close to, or they were in single digits. Back when the rise of games, physical copies of games were popular, it maybe rose a little bit around 2013, when the Xbox came out, or when there were physical copies of games being sold. And then as games started to go digital, it went closer to bankruptcy levels as we validated, and the stock price just continued to decrease. But looking at August 2020 or 8 of 2020, we can see here that the open price was $1.01, the closing price is $1.67, and the low was $1, and then the high was $1.79. So we can see here that claim of GameStop being shared at 4 cents in August of 2020 is false. So we can verify that with historical figures, which we did with Yahoo Finance. We saw, looking at the beta, was negative 1.3 at that time, which means it moves opposite to the market, so it had a negative correlation, which means it just continued to go down, but was not quite at that 4 cent range. It may have been a calculation error, miscommunication error that made the professor think this. Just the way we can communicate that error that was found is just, using our voice in class to talk about this error or sending an email to the professor. Moving down to the represent stage, like we said, the goal here of this stage, mapping out, visualizing mentally timeline of events and how the returns reflected the change in the timeline. And then looking at the systematic approach to testing market efficiency. And this can help us to see abnormal returns, drift, and any other key factors we need to analyze. So kind of looking at the short squeeze, or what a short squeeze is, what happened in 2021. It's a short squeeze is when many investors short the same stock and the stock's price starts rising unexpectedly. So in the case of the Wall Street Bets Reddit subreddit, led by Roaring Kitty, a guy with the Reddit username that, and also had a YouTube account named after that. He was releasing videos about that stock on YouTube and caused a whole influx both on Reddit and on YouTube of people to invest in this stock to drive up the price, causing a short squeeze and the stock to increase by hundreds of dollars a share. So then validating the timeline of the stock, which I used with this, thestreet.com, looking kind of at the timeline of events that was given to us. So, starting in August 2020, we see the end of August 2020, the games, I guess maybe there was insider information about Ryan Cohen wanting to purchase some shares of GameStop. So the price was going up to $6.68 at the end of the month, even though we already looked, it was around $1. And then just going through the different information about Ryan Cohen before the short squeeze of Roaring Kitty, which happened in January of 2021. As you can see here, it happened right here on the 27th, getting the short squeeze around $380, up to around the $400 range. So we can see that we saw, like we said already, in August 2020, the GME was nearing bankruptcy levels. In September of 2020, Ryan Cohen acquires the stake of the company, buying the shares outstanding. The Reddit account surged the price to $483 in January of 2021. February of 2021, the congressional hearings on market manipulation, and then the post-event price stabilization, which, like we saw here, after the super high spike in the price in 2021, the stock has gone down to more normal levels. There were a couple, it's still higher than it was before the bankruptcy levels, but still stabilized a little bit. And then, so that's just validating the timeline, and then looking at the return calculations. What we're going to use in our implementation stage, just kind of drawing those calculations out, looking at normal returns, abnormal returns, and then cumulative abnormal returns. So normal returns is the expected return on a stock if the event had not occurred. So that would be the average return plus the systematic risk times the market return on day T. Then the abnormal returns calculation would be just the difference between the actual observed return and the normal or expected return. So the abnormal returns, if it's higher than the expected return, that chunk between the observed return and the normal return will be what our abnormal return was. And then, if normal is greater than the observed, then we'll have a negative abnormal return, just showing that we actually observed less than what we were predicted to be. And then the CAR, or cumulative abnormal returns, being the total abnormal return over a defined period. So after calculating the abnormal returns for a bunch of different days or time periods, summing all those up over the course of the event, which we'll do in our implementation stage. So now, going down to implementation, I had help from Google Gemini to debug it in Colab because it wasn't working after generating it in actual Gemini. So there's a lot to go through here. It made some changes here, but gets the market data. It has the ticker of here, and at least I have a few cells of implementation here that you'll see in a second, but GameStop compared to the stock of the S&P 500 as a market proxy, and then the different dates they started the squeeze, just the very beginning of it in January, and then the initial 13% stake that Ryan Cohen bought in the company. So just to run it to make sure that it works. You can see the check there. We go down to look at, first we'll look at this visualization that we made between the starting in 2019 all the way up to 2022. So just 3 years of looking at the comparison between the benchmark, the S&P 500. You can see this drop here due to COVID-19 around March. As we all know, that was not good for the market, but just the constant increase and rebuild of the S&P 500 after that. And then down here, this blue line shows the low returns, or low closing price of GameStop, and then the crazy price increase, the price hike to around $8 a share then, and then how it decreased back to stabilize out before rising back up again. But still, we see how that the event and the market or the restrictions on trade caused the decrease back to lower returns after the price hike seen from the short squeeze. But looking up to what we actually want to know, the efficiency test that we calculated from the September of 2020 and the January of 2021, just looking at the cumulative abnormal returns that we calculated from the pre-event, the day of the event, and the post-event drift, we get 42% or 0.42 drift from day -20 to day -1, which is leading up to the event before Ryan Cohen invested in the stock. Then the event day being negative, so a drop in the drift, and then the post-event drift being 0.69. So, or not 0.69, that's just the total over the whole window. The post-event drift being 33%. And then, as you can see, we got just shows relative days to the stock, just a quick head of the change there, how the market return compared to the stock return, the actual returns here, reflect, not very large numbers, still only like 1 to 2%, not even 1% someday, and sometimes it's dropping by 1%, sometimes it's raising by 1% point, but then the abnormal returns, are a bit higher over time. And then just the cumulative average returns, or abnormal returns, not average returns, being in daily being around the 13 to 20%, or not 13 to 20, 12% to 20% range. Just to get an idea for how this code works. And then looking at the next event being the first January of 2021 and days leading up to the event that happened there. We see this is still a little bit before the actual short squeeze, but we can see, leading up to that, there was negative drift. Then the day of the actual start of the short squeeze, it was 56% drift. And then days after that, we see almost 200% here, because 2.54, 200% drift. So it's just reflecting the actual short squeeze there and the efficiency, and kind of leads us to think about what is actually driving this. So again, here are the the event window data, just showing, days leading up to, or this time it's showing days post event, but still showing the much higher returns, market returns, normal returns, and the abnormal returns, and then 300%, 200%, just around 300% for the cumulative abnormal returns, just showing super high returns there. And then just looking at the next, I made another couple of graphs to actually show the short squeeze abnormal returns in a graph. So run this. This is the actual event day of the short squeeze, or the day after when the trade restrictions were imposed with Robinhood. So just 20 days before, 20 days after, we see this graph here shows how, these days were nearing bankruptcy, or the returns were not that good. And then around 13 days before the short stock, it started to rise. And as more and more people were investing in the stock and surging the price to its peak of the abnormal returns of almost to 300%, about 2.75, 2.8% looks like up here was the peak, just showing that crazy spike in the abnormal returns. And then right here on this red line, the day after was when the trade restrictions were imposed. People were beginning to sell their stocks because Robinhood was letting people sell their stocks for a short period of time, but not letting more people buy into the stock. And then just the days after, showing the stabilization of the stock, or it's not quite the stabilization period yet, but having less returns as more and more people are selling their stocks, and the stock is not becoming as valuable from the squeeze anymore, as well as some of the federal mediation as well. And then just one more graph that I made to actually show the same graph that we saw already, but the day by day with the bars here, the day by day cumulative, or daily, not cumulative, daily abnormal returns. So as we see from day to day, starting from -20 to -15, or the days leading up to the event, it was mostly negative to the most part. People weren't really gaining money on the stock until, around the short squeeze started, and the returns began to increase by a lot up until the point of the event. And then the day of, as people were starting to sell the stock, the abnormal returns were decreasing. Just a cool graph to look at. Now we move on to the validation stage here. Like we said, looking above, the graph of the benchmark versus the GameStop shows negative correlation of betas, because kind of looking back up here real quick, we see as this is rising, this is sort of decreasing or just staying stable. So like we said, GameStop had a negative beta. Benchmark S&P 500 has a beta of 1.0. So it just shows, this one at this time of the spike had a lot of volatility, and then just began becoming more volatile, but going in the wrong direction. Going back down to validation stage. Like we did, we already compared the figures calculated to online research, and then another way to validate our answers was with statistical significance and robustness checking. So a way to calculate statistical significance, looking at are the abnormal returns significantly different from zero. So the period we tested was from the 20 days before the event happened to 20 days after. So to calculate our t-value here for our t-statistic, we did the cumulative abnormal returns divided by the standard error, divided by the standard error over the, or not over the, this should be times the standard error of the abnormal returns times the square root of the amount of days. So 40 days total. That gives us our t-statistic, and I had Gemini do these calculations for us, and we saw that during this event window, the t-statistic was very high. Sorry, I cannot talk tonight. And the p-value was a lot less than 0.001, or alpha here. So abnormal returns are large and significant, meaning that the event almost certainly caused the stock's price to move, or the social media influence and overconfidence hurting All of those behavioral factors influenced by the Reddit posting and YouTube video of Roaring Kitty caused the stock to move. And then looking at just a risk adjustment as well, our abnormal returns compensation for additional risk. The abnormal returns seen during the GameStop squeeze were not rational compensation for additional risk, and we know this because behavioral factors and social media communication drove up price. And these people investing were not looking for extra risk; they were just trying to make a statement, as we looked at, and a lot of people, thought this was an opportunity to make some extra profit, but as we saw, it was not really in a systematic way. It was in, sort of a way of rigging the market to try and beat the market and make a statement. Returns were the temporary result of a speculative bubble and a market structure failure, as well as manipulation, like we talked about already. So a way to test robustness of this check would be run with a larger time period or a different time period rather than the 40-day one that we used, and maybe doing a sensitivity analysis as well. I talk about robustness checks as well in the evolve stage, but this is what I have for the validation stage. So moving down to evolve, doing what we did here or what I did in the stages, you applying these efficiency insights to the different market anomalies and market biases. So looking at the behavioral biases here, a lot of these did apply to this situation and caused the price to drive up and show why we weren't dealing with systematic risk, but it was more of an unsystematic way of dealing with it. So overconfidence, like we said, the investors on Wall Street Bets subreddit became overconfident in their collective ability to beat Wall Street. And then, both sides, the retail and institutional sides, in January of 2021, both displayed overconfidence, which amplified the volatility of the stock. For anchoring, this was definitely another big part of the short squeeze, as investors may have anchored on GameStop's historical low prices. And this caused irrational price expectations and poor timing decisions during and after the peak. For herding, large numbers of retail investors followed this Wall Street Bets community's momentum without conducting individual valuation analysis, which arguably is the most significant part of the short squeeze, because a lot of people were following the social media posts, the YouTube videos, the subreddit, memes and screenshots as well of the large profits triggered by the short squeeze, and this caused fear of missing out. And more people, even as the price was going up more and more, people were buying even more to the point because they wanted to, make this short-term profit off of the stock, especially using Robinhood. The price was moving not because everyone else was buying, but because of new information here. And then loss aversion after prices fell from the $400 highs. Investors refused to sell at a loss, holding on to their hopes of another rally after they invested, thousands and thousands of dollars into it. This kept long-term and short-term investors in positions far longer than rational analysts would suggest, which worsened volatility. And then for market mental accounting, retail traders viewed GameStop investments as fund money or a statement against Wall Street, not as a part of a rational portfolio. And this reduced sensitivity to risk, encouraging irrationally high exposure to a single volatile stock, which in turn hurt the rest of the market. It did result in a government intervention. And then some of the market anomalies that we looked at, kind of seeing if those aligned with what happened with this investment story. Looking at momentum, GameStop was not doing well before, so the sudden change in the earnings does not quite align with this concept, or at least not until the short squeeze start. As trading was accelerated by algorithmic trading and social media amplification, creating a self-fulfilling cycle when prices attracted more buyers. For the value effect, investors like Ryan Cohen, when he invested in the stock, saw long-term value in restructuring the company's e-commerce strategy because of its low trading levels. And after January 2021, the price was no longer driven by fundamentals or intrinsic worth, but by speculative and behavioral forces. So in turn, this negated the value effect. So far, momentum and value effect do not apply to this. The size effect here, the small size made it more susceptible to volatility, retail coordination, and short squeezes, which we saw with the Wall Street bets and all of the followers investing in the stock. So it was more vulnerable to price manipulation and momentum shocks, and it was easier for the group to manipulate it. So the size effect is amplified there. And then the January effect, looking at smaller stocks doing better in January, which we did see that this smaller stock or this lower price stock had its short squeeze in January, but this was with the help from the Reddit group that manipulated the value and drove up the price. So the drivers of price were different, being short squeeze and social coordination rather than the seasonal behaviors of this effect. So then just another way to improve robustness here, or how to expand this analysis, is, like we talked about already, using a longer pre-event period, maybe like 120, 250 days of trading before the event window rather than only single or double digit event amount dates. So we could also test with the CAPM model to strengthen our argument that the results are not model specific if the abnormal returns persist. So branching to other concepts that we've learned in Management 310 already could help us to strengthen our argument as well. So it's like doing a CAPM model. And then, like we looked at the comparison of GameStop to the benchmark to compare the betas of the two stocks, or the market to the stock. We could try a different market index like the NASDAQ composite to test sensitivity analysis or performance sensitivity analysis to further strengthen our argument. So now for our last part, the reflection stage, last part of driver, some of the things that I took away from this assignment and what I've learned, or the key takeaways that can be taken away from this. Like we saw, the market is mostly efficient unless a factor like something behavioral or arbitrage or collusion messes with it. Like we said, we ran over the behavioral biases and the market biases from above, or the market anomalies from above, and this shows how those factors can drive up stock prices temporarily, specifically the behavioral biases. Looking at abnormal return, it reflected the difference between what GameStop's actual returns were and what the expected earnings were from the model. Like before, GameStop's expected returns were very low, being close to bankruptcy levels, but the short squeeze here showed the price drift that can be used to determine efficiency. Just kind of looking at the short squeeze and seeing how the different types of efficiency using the efficient market hypothesis could have been violated, which we'll go into in just a second here. Could rational investors have profited systematically from this? The price increase was not driven up naturally or by new information, but rather hurting the social coordination, etc. And we did see some investors profit from this. Some were smart to sell their stocks as it was keeping before, Robinhood stopped accepting profits or buys of this share, and before there was government intervention from Congress. But the systematic and rational profit was extremely unlikely, as this wasn't done systematically or by one's own knowledge, but rather by the social influence from the Reddit. And the short squeeze was highly unpredictable. Market frictions and trading restrictions from Robinhood after the event. We saw the high volatility of the stock undermines the systematic strategy because it was highly volatile after the short squeeze. And then just kind of going over the results of the market efficiency form testing. We saw the weak form market efficiency was not directly violated because the rise was not a repeatable thing to happen because government won't let it happen anymore. Rather, it emerged from new non-price related factors, both social and structural, as they found a loophole within the system. The semi-strong form was violated as non-fundamental information, aka the Reddit discussions, created irrational mispricing inconsistent with semi-strong efficiency. And strong form market efficiency was violated as market constraints and limited arbitrage capacity revealed that all information was not instantly or equally reflected in the prices. So then just some last key takeaways, as this is a very long video, I apologize. But just to sum everything up, EMH holds in theory but weakens under social and structural strain. Behavioral anomalies can cause temporary inefficiency, but markets will eventually return to normal, as seen with GameStop today. Just kind of looking at that, looking back at Yahoo Finance, it's at $21.32 today, and it is not at its super high level, but it's again not at bankruptcy levels anymore, but still went down and still looks to be super volatile. And then just last thing, a market can be efficient on average, but still experience short bursts of chaos in its pricing, as we saw with this. Although it's unlikely now, after the lesson that was learned from all parties from this story, this chaotic series of events, it likely won't happen again, but the market can still be efficient on average, even if some of these things happen. So thank you for watching this very long video, and yeah.